Thank you to the organizer for the kind invitation to this session. As you will see, I'm going to present a paper we recently performed in collaboration with the Italian Regulatory Supervision Authority, which is CONSOB for financial market. It's going to be pretty different from the previous talk, essentially because this is a lot based on data, a little bit on models, but on statistical models in some sense. And second, because of course the topic is also slightly different because it's related to finance. As I said, this is a work done in collaboration with two people from Scuola Normale. One is Piero Mazzarisi, which is now in Siena, and Adele Ravagnani, which is a PhD student, and three colleagues working at the CONSOB. The CONSOB is the Italian Regulatory Authority for Financial Market. So what is the problem we have? So our problem is the problem of insider trading. Okay, so the problem is let me define what insider trading is. Insider trading is in general is the unlawful practice of trading, exploiting non-public confidential information about a listed company. And of course, if you know in advance something about a company that you shouldn't know, then of course, and you trade with this, then of course this is illegal. Okay, and what you want to do, what the supervising authority wants to do is to find people that are doing this. Typically, this type of event occur in vicinity of what are called price-sensitive events. So events which are very special, like for example, a takeover bid or a release of some information, which is not public in some sense, and people maybe working at the company or close working to the company know in advance and trade accordingly. And of course, this is prohibited and criminalized in most jurisdictions around the world. Let me show you some examples of real insider that has been detected in the past before moving to the main part of the paper. So this is a guy, Ivan Bersky is one of the most famous insider. This is a guy who was in the US, and he was essentially having a lot of friends in the major banks that were giving him information about important event occurring in the company, and he was trading on this information in a legal way. And he was essentially, he ended up profiting from every major merger and acquisition in the 80s in the United States, making a huge amount of money. But eventually, he was sanctioned by the SEC, which is the equivalent of the CONSOB in the United States, and he was sentenced and got a 100 million fine, and so on and so forth. Actually, this guy, you don't know. Oops, sorry. To understand how this works. This guy is also at the basis of another guy that you probably know. This is a very famous movie. It's called Wall Street. And Wall Street, the character of Michael Douglas in Wall Street is exactly based on this guy, Bersky. And in fact, so it's Gordon Gekko, probably you know him. And I mean, I'm just reporting some sentence that allow you to understand why all this is relevant. So one sentence is the most valuable commodity I know is information. And every battle is won before it is ever fought, in the sense knowing information in advance. And essentially talking with Charles Sheen, which is a young guy, he say, okay, it doesn't matter that you're very smart in mathematics, right? That you are a very good statistician. I have 20 quants that I can do charts and sophisticated analysis. All what I want to have is information. And in fact, all the movie is around the fact that Charlie Sheen has to spy essentially some investor which is about to purchase a company, and what Gordon Gekko does is to buy in advance of this guy and reselling to this guy at a higher price. And this, of course, is insider information and is illegal, as the movie shows. However, the last important point is that insider information sometimes is not only individual investor activity, but it is also a collective phenomenon. In fact, there are a few cases, one very famous in Italy, where essentially there are what are called insider rings. So groups of investors, maybe working in different companies, they essentially synchronize themselves, sharing information. Of course, I'm working in a company. I cannot trade on my company, but maybe Giulio is working on another company, and we are friends. And essentially, I provide him information about my company, and he provides information to me about his company, and we trade. And actually, CONSOB was able to pick up these 20 people, essentially working in many Italian companies, and they were fine. And this is called insider rings. Okay, so what we want to do, okay, this is an example of, this would be our guinea pig. I mean, we have in the paper many different examples. This is a takeover bid happening in a company called IMA. And essentially, you see that there was a takeover bid at this date, and essentially at this date, the price increased in 1 day by 13%. Of course, if you know in advance that the merger and acquisition is going to happen, then you can profit a lot from this information. The problem is, how can you identify persons that are knowing this information in advance and are trading in an unlawfully way. So the goal of the paper, therefore, is to provide a methodology based on essentially on unsupervised machine learning techniques, able to provide an indication of potential inside, or anomalous, if you want, trading activity that then should be scrutinized by the consul in order to find potential investor. Of course, this is not an automatic mechanism that tells you, okay, now, given they observe this, then you should be fine. This is just the starting of an observation. As you will see, machine learning statistical method can provide a very great help, especially because the dimensionality of the data, as I'm going to show you, is huge. The idea behind this is be able to identify discontinuity in the trading activity of investor. And the idea is that the more discontinuous an investor is, trading of the investor is, the more suspect he or she should be. So what does it mean to be discontinuous? Well, we identified essentially 3 different types of discontinuity. So the first one is a temporal discontinuity, which means I trade in a way which is not predicted by some model. Okay, so I build a model of my trading activity, and in a certain period, which is the period under investigation, I find that my trading is anomalous with respect to what I'm expecting. Okay, so what the model tells me. Then, of course, another possibility is to say, okay, maybe I behave in a different way, but all the other people that more or less follow my strategy also behave in a similar way. So what you should do, and this is the intuition about the paper, is to identify peers, group of investors that trade in a similar way, and then identifying someone which is trading in an anomalous way with respect to the peers. Okay, so maybe we all follow the same idea, and so we should move all buying, for example, in a certain way, but then at a certain point I sell. Okay, but that it's suspicious because I trade in a different way compared to what the others are doing. And then the last point, of course, is this coordinated discontinuity, so what is called insider rings. And so we're going to provide method to identify this sort of anomalies. Okay, in order to do this, you need data. Okay, and this is where Consob is very helpful, because data, Consob has provided us a very, very fine-grained data, which is a database collecting the daily activity of all the investors in all the stocks of the Italian market for a period of 3 years. Okay, so we are talking about 2 million investors for every day, and for every of the 100 stocks that are traded in the Italian stock market, we know how much the investor bought and sold in each day. It's a very heterogeneous set because you have company, household, small trade, and so on and so forth. Big companies, in fact, typically you observe this type of very big heterogeneity in, for example, the number of trading activity days, and of course, very sensitive data, as you can imagine, because they are anonymized, of course, but nevertheless, it's still very sensitive. And of course, we have a data set containing some price-sensitive event that we want to investigate. In particular, we focused on takeover bids in the Italian stock market. So for each investor, essentially, when we take the stock under investigation, we can monitor essentially the time series describing the trading activity of the investor. So imagine that this is the time, this is the asset exposure, so how much I buy minus how much I sell, and this is one investor, okay? And I have 2 million, I mean, in general, I will have thousands or hundreds of thousands of time series like this, okay, of the guy which is buying, doing nothing, and at a certain point, this is the price-sensitive event, the guy starts to buy, okay? And then essentially, this is the kind of time series that you have in mind. So what is the idea behind our approach? Well, the idea, of course, is try to featureize, as people say, the time series by identifying some relevant statistical property of the time series of the trading activity, which represent the state of the investor, the activity of the investor in a given time window. So in this case, you can imagine that each of these points represent one investor. This will be one specific of the investor we are considering, and we consider here 3 possible features. Of course, you can extend the number of features. For example, this is the maximum exposure during the period. This is the aggregated turnover within the period, so some quantity that you can extract. This is not so important, that you can extract from the time series, and this is essentially is the amount that you trade in this stock compared to how much you trade in all the other stocks. Of course, this is important. Suppose you never trade IMA, and then at a certain point, few weeks before the price-sensitive event, you start trading this company. Well, this is suspect in some sense. Why? Why are you trading exactly a few weeks? You never was interested about this. And so essentially what you have a cloud of points in this space, each of them describing an investor. But each of these points, of course, represent the activity in a given time window. And in reality, what you're really interested in is two things. So first of all, you want to identify groups of investors in this space. So essentially what you need to do is to apply some clustering techniques that allow you to identify groups, so the peers I was mentioning before, right? So in this case, we use a very simple technique, k-means, but again, you can be more sophisticated. And so eventually in this space, you will identify groups. Each groups correspond to a different, probably types of investor. This is an unsupervised learning technique, and this represents probably a given strategy. So the violet one will be the peers, what we call the peers of the black investor here. The other important point is that we have a dynamic system, so a system that evolves in time. And in fact, we want to see how the behavior of all these investors change in vicinity of the price-sensitive event. So you should imagine, of course, that each investor is represented by a trajectory in this space, okay, representing essentially how the investor move. And the idea is try to identify anomalous trajectories in this phase space. And essentially, we can have a continuous behavior. So essentially, you have an investor that is belonging to the violet cluster. Also, the cluster, of course, move, right? Is always belong to the violet cluster, and therefore, I mean, it's not suspicious. It's behaving like its peers. But then you can have a discontinuous behavior. So an investor that initially started in the red cluster, and then in the vicinity of the price-sensitive event, move to the violet cluster. That's suspect because his peers or her peers didn't move, but he moves and in a way which is completely different. And then, of course, these are called the soft discontinuous investor. And then you can have what are called the hard discontinuous investor. These are investors that actually never appear before in this setting because they never traded asset. And then at a certain point they appear at a certain point in a cluster, maybe in a cluster which is the suspicious cluster in some sense. So they will be called the hard discontinuous investors. So the idea at the end is to help the consob to provide with a metric that identify the discontinuous investor, hard and soft, and to provide a metric that tells you how suspicious the guy is. And so this is what we did essentially we identify this point here. I'm not going to explain why, but this point here as the point of the maximum suspect investor is the investor that never traded that asset, that do all in on the investigated asset, that is in the rewarding direction. So for example, buying if it is a takeover bid and so on and so forth. And so essentially the distance of the point from this vertex or some linear transformation of it represent in some sense a degree of suspect, the degree of suspiciousness, I don't know if it exists in English, for the specific investor. Of course, only for the discontinuous trader. And okay, in this case, these are real data now. Before were just not real data. So this is stock EMA. In this case, there were 5,000 investors trading in the period. These are the cluster which are observed, and there are 379 investors in the rewarding position, not all, which are very close to this vertex of this hypercube, of this cube. So they not necessarily are suspicious. In order to be suspicious, they must be discontinuous. And in fact, we identify the discontinuous soft and the discontinuous hard. So the soft, I remind you, someone who was present in the previous time in this phase space, but then immediately before the price-sensitive event move into the suspicious cluster. And then 237 hard, which are investors that was never before in this box, and suddenly they appear in this line. And so at the end, we provide with this list. I mean, of course, you have the anonymized ID. These are the type of investor. I mean, if they are household or legal entities, and also the score. This is the amount of shares and the expected profit out of this activity. And so this is a ranking that you can provide to the supervising authority that actually they start using it in order to say, okay, this is the most suspect one, this is the second one, and so on and so forth. And so they can start, of course, investigating whether there are reasons for which, for example, this investor had some sensitive information and was maybe liable of insider trading. Okay, the second aspect instead is the collective phenomenon part, right? I mean, the idea that people are trading in a collective way, they share information and they trade as insiders. Okay, so essentially what we did, so in order to identify the insider rings, so we simplify a little bit the problem by characterizing the trading activity of each investor in each day by 3 states. Okay, either well, one state is of course that the investor does not trade that specific asset. The other one that the investor is buying, the other one is selling, and the other one is buying-selling in the sense that in the same day approximately buys and sells the same amount of shares. For example, these are called daily traders, right? Investors that buy in the morning and sell in the evening, for example, or market maker or whatever. Okay, then essentially the idea is to try to find the similarity, to build a similarity network of the investors, obtaining cluster of investors with similar trading activity, and identify suspect clusters. So now, by looking at the similarity in the trading behavior, we try to build clusters, and we observe then the cluster, not the individual, with respect to the peers. Okay, so just to show you graphically before going to the methodology, imagine that you have simply 1, 2, 3, 4, 5, 6, 7 agents. This is time. Okay, these are the 7 investors, and the circle tells you that, for example, this investor is sorry, I forgot the color, but this is buying here, and green means selling, and blue means buy selling, and black means that the investor was not active. And this is the price sensitive event. So what do you want to do? So what you want to do essentially is to make a permutation of this data in such a way to transform it in this way. In such a way that you have a cluster of investors. These are the same data simply sorted with a different permutation, where you observe that there is a cluster which is buying in a very synchronized way before the price sensitive event, which is here, and then selling immediately after. And that's, of course, is a suspicious cluster. So essentially the problem is try to find this permutation on the data and clustering, and of course finding that this is a cluster of the data. Of course, the problem is very complicated because in reality, right? I hope. Yes, it is. Because in reality, this is what you see. These are your data. Okay. So the data now, I use white instead of black, right? Because otherwise it would be unreadable. Essentially, so the problem is, this is the price sensitive event. These are the 5,000 investors. Okay, these are their trading activity through time. So essentially what you want to do is to do a clustering of their activity through time. So the idea in order to do this is actually make a use of a technique we developed with Rosario Mantegna and collaborators more than almost 15 years ago. The idea is to map the previous system into a bipartite network where you have a set of nodes which are the traders and a set of nodes which are the days. Okay, and there is a link if this investor is trading in this day, and the color, there are 3 different colors, depending if you are buying, selling, or buy-selling. Okay, so it's a bipartite network of the setting. Then essentially what you do, you look at the projected network, right? So you make a projection on the side of the investors, and there is a link if the 2 investors were trading at least once in the same days. For example, these 2 investors were trading while this is buying and this is buy selling, when this is buying and this is selling, when this is buying and this is buying, when this is buy selling and this is selling, right? So you have all this network almost completely connected in some sense, where you have the co-occurrence essentially of different states of the network. And of course, in each of these, you might have a number of days in which they behave in a similar way. Of course, this is very dense and is not very helpful, and doing clustering on this would not be very smart. So at the end, what we did is to use this idea of statistically validated network that we introduced 15 years ago, which essentially try to make a statistical test on the null hypothesis that the number of co-occurrence is random. And in order to do this, you have to use some statistical test, which is called hypergeometric test, that you can apply for each pair of investor and for each pair of trading activities. However, you are doing a huge number of tests, right? Because you are testing all the possible pairs and all the possible pair of activity. So the number of tests is huge, and you will have a huge number of false positives. So in statistics, there are methods for tackling this. This is called multiple hypothesis testing correction. One of the most important ones is what's called the Bonferroni correction, which is the one we're going to use, which essentially tells you that if you want 1% confidence on your data, then you have to, the real p-value you have to consider is 1% divided by the number of tests. Number of tests is huge, right? Imagine 5,000 times 5,000 multiplied by 9. I mean, really a huge number of tests. And so you can get a very, very strict p-value. Once you have done this, only few links will remain in this network. So you will have a proper network, sparse network. You apply some community detection method on this cluster. We use the info map, but as a matter of fact, it doesn't matter much. And then you try to identify these clusters of coordinated behavior. And so essentially you find a group of investors that look very synchronized. And among the clusters, you look at those which are suspect because synchronized in the right way, in quotation, around the price-sensitive event. Okay, so this is an example. So this is one of the clusters that this is one cluster, okay? This is one of the clusters that our method identified. Okay, I hope you see it, right? You see that these are, I don't remember how many investors are here. There are many investors here. And essentially what you see that the method is able to identify this from the, the white figure I was showing to you, very synchronized behavior among these investors. So there they were all buying, all selling, buying, and so on and so forth. Of course, this is not particularly suspicious in our setting, but this is to show you the capability of the method of identifying very synchronized group of investors that are trading simultaneously. These are other clusters, okay? The vertical blue line separates different clusters. You see again, some of them are extremely synchronized. Some of them, also here, for example, you have a cluster of very synchronized, and some of them are very, very small. And so in this way, using this very strict statistical threshold, you are able to identify extremely synchronized group of coordinated behavior. But I mean, this is nice. We did it with Rosario Mantegna many years ago with some Finnish data. We are really interested in looking at coordinated and suspicious. And for example, this is an example of suspicious cluster for this specific takeover bid. This is a cluster, right? You see this group of 4 investors. I mean, they never traded the company before. Then few time before this is the price sensitive event, okay, when the takeover bid was announced. I mean, these guys were starting in a coordinated way to trade, to buy until when the takeover, the price went up by 13%, and then they sold after that, making a lot. And you see there are few other of them which are really probably inside the rings, very coordinated behavior occurring in vicinity of the takeover. I mean, the strength, of course, is the methodology of finding this very synchronized cluster. I'm done. Of course, I don't have time, but I want to mention that in reality, you have a network. At the end, with the statistically validated network, at the end you have a network, okay? A very sparse network where you have investor linked if they have a very strong similarity in their trading behavior. And so this method can also be used in a different way. Suppose that Consob has some suspect about Giulio again, right? And say, okay, for some reason, because I don't know. And then say, okay, but let's look who is trading in a similar way like Giulio, okay? You can use this method by looking at the first neighbor or the second neighbor by using the statistically validated network and find other person that may be connected in a statistical sense with Giulio and try to explore essentially other potential suspect investor. And this is so using essentially this method to explore other potential suspects. Okay, I think that's it. Essentially, the idea was to help supervising authority with some machine learning method to identify suspect of insider trading. Of course, the challenge is the high dimensionality and heterogeneity of the data. We propose 2 methods for doing this, one based on unsupervised clustering and the other one, which is also a form of unsupervised clustering, but it is the statistically validated network. And this, as far as we know, this has been used now, implemented by the supervising authority to at least give them, help them to scrutinize among this huge amount of data, which are the first suspect that you should start investigating. Thank you for your time.